This following presentation contains forward-looking statements which reflect management's best judgment based on factors currently known but involve significant risks and uncertainties. Actual results could differ materially from those anticipated in these forward-looking statements as a result of a number of factors, including but not limited to risks described in the company's forward-looking statement disclaimer. Accordingly, viewers should not place undue reliance on forward-looking statements due to the inherent uncertainty therein. If you are contemplating trading in the securities of Buchans Minerals, we strongly advise that you seek independent professional advice before making any investment decision.
Hello, my name is MacLeod, President and CEO of Buchans Minerals Corporation, and I want to talk to you today about our Woodstock Manganese project in New Brunswick, Canada. In 2010, we acquired the Woodstock property based on a historical resource of about 146 million tons in 3 deposits. The Plymouth deposit is the deposit we've been focusing on primarily, which has a non-43-101 compliant historical resource of about 46 million tons, grading 11% manganese. Now the first question I get from people is, how can an 11% manganese deposit compete against the South Africans who have deposits grading 40 to 44% manganese? Well, the answer is simple. Those deposits in South Africa are oxide deposits, whereas ours is a carbonate deposit. The two different ore types produce entirely different products for different sectors of the steel industry. Oxide deposits produce a 50% concentrate that's sold to smelters that produce ferromanganese and silica manganese to produce long steel and flat steel for the steel industry. Whereas carbonate deposits use hydrometallurgy to produce high purity manganese products, primarily electrolytic manganese metal, or in short EMM, which grades 99.7%. If you want to get a better sense for the value per ton of ore for a manganese carbonate deposit compared to, let's say, an oxide deposit or even a gold deposit, it gets even more interesting. A 12% manganese carbonate deposit using a price of $1.54 per pound of EMM, which was the 2011 average price, and a 90% recovery, you're looking at a value per ton of ore of $378 per ton, which is very high. It's very significant. Compared to, this would equate roughly to an oxide deposit with a grade of around about 40%. Or if you looked at a gold deposit, that would equate roughly to a gold deposit with a grade of around 7 grams per ton. And if you use the numbers for the gold deposit of $1,720 per ounce of gold and a 90% recovery, that's what it comes out to, an equivalent deposit of 7 grams per ton. Now that's significant because most gold mines have grades around about 1 to 4 grams per ton for an open pit gold mine, whereas our manganese Plymouth deposit has a value that's equivalent to around about a gold deposit of a grade of around about 7 grams per ton. That's big, that's significant. And it's important as a shareholder that you really start to understand just how valuable the Plymouth manganese deposit could be in terms of its value per ton. If you look at the EMM market, it's grown by 538% over the last 10 years. Driven primarily by the Chinese switching to the production of 200 series stainless steel, which uses more EMM to replace nickel. Now, a recent report by CPM Group is projecting that the market's going to grow even further from the existing 1.5 million tons to 2.8 million tons in 2021. But it's not just the projected growth in the industry that's got our attention and got us excited about developing an EMM project to come into this market. But it's also the fact that the market right now is actually dominated by the Chinese, who produce 97% of the world's EMM, but they have a highly fragmented industry with high operating cost, which has identified to us that there's a window of opportunity here for someone who can produce a project that has low operating costs. Right now, the Chinese have 600 manganese mines, mostly underground mines with high operating costs, and 188 EMM plants with an average capacity of only 7,000 tons per year. Now our base case is going to be looking at producing 50,000 tons per year. The Chinese only have 5 projects that produce 50,000 tons per year or more, but their operating costs are actually very high. If you look at the CPM Group, they're projected to be between 81 cents per pound of EMM up to about $1 per pound of EMM. Whereas if you look at the Shanghai Metals Market report, they're looking at the operating costs in China somewhere between $1 per pound of EMM up to $1.10 per pound of EMM. Now all the work that we've been doing on our project is identifying that we believe we could become a low-cost producer and compete with the very lowest cost producers in China. Our target would be in the 80 cents range, but I qualify that by saying that's only a target and that the work that we're going to be doing in the future in the PEA is going to be aimed at nailing down that operating cost as we go forward. But it actually gets even more interesting when you look more closely at the Chinese industry. Not only has it got high operating cost and is fragmented, they're actually reducing their capacity right now from the 2.2 million ton capacity they have right now to around about 1.3 to 1.5 million tons. So they're shutting down their smaller capacity plants right now. So their capacity going in the future will only just cover the existing demand in the EMM market, let alone the future demand going forward. But we're actually quite excited to try and come in and compete with them on a head-to-head basis on a low-cost scenario. Internationally, the Chinese operating costs are actually higher because the Chinese right now are trying to protect their source of EMM for their internal steel industry. By doing that, they have a 17% VAT charge and a 20% export tax. So the effective operating cost for EMM producers in China to sell outside of China is probably around about $1.25 per pound of EMM. So if we're coming in at a cost around about 80 cents per pound of EMM, we're going to be highly competitive with the Chinese into the international market, and that's what our primary focus is going to be. But even if we did decide to try and compete with the Chinese on selling EMM directly into China, we are going to be very competitive with the Chinese and their most efficient plants if we are able to achieve our goal of around about 80 cents per pound. Once again, I qualify that by saying we do have a lot of work to do to try and find out exactly what those operating costs are going to be as we move towards completing a preliminary economic assessment. So moving this project forward over the last year, the first thing we did was drill 5 holes into the Plymouth deposit that were successful in confirming the historical grades and the geological widths, but more importantly provided us fresh samples to complete a hydrometallurgical bench scale program. We've been doing this program now over the last 6 to 8 months, and we've been successful in testing it through the leaching process and the precipitation process to produce a high purity electrolyte solution prior to going into an electrowinning circuit. And theoretically, from that solution, we can produce a 99.7% electrolytic manganese metal once it goes through an electrowinning circuit. Our next phase of hydrometallurgical test work is going to be working on actually producing metal through an electrowinning circuit and also optimizing our leaching circuits and our precipitation circuits. And that's going to be incorporated into the PEA as we go forward. But more importantly, this hydrometallurgical program has been linked in to a dynamic economic model using METSIM. This dynamic economic model has allowed us really to identify what the economic drivers for this project are, and really it comes down to the operating cost. About 70% of operating costs are comprised of our sulfuric acid prices, power prices, and fuel costs. And we've been working diligently over the last 5 months to try and nail down those costs. So we've got a fairly high level of confidence right now that our target of becoming a low-cost producer is potentially realistic. Once we get the PEA done, hopefully we'll be able to demonstrate that over the next 6 to 8 months. Now, I'm really excited now because I now have a plan mapped forward with the fact that we've just signed an agreement with Minco PLC to become our partners in developing this project going forward. The deal that we've struck with Minco is such that they'll first spend $1.25 million to drill off an inferred resource in the Plymouth deposit to earn a 10% interest in the project. Thereafter, they can choose to go to completing a preliminary economic assessment by spending an additional $750,000 to earn an additional 10%. And thereafter, they can earn up to 50% in the project by completing a pre-feasibility study on the project. So right now, from a company perspective, I'm very happy because my 2 main assets, my base metal assets, as well as my manganese assets, have partners who are both Minco and are developing those projects moving forward. So our treasury of $1.6 million, I'm not going to be spending a lot of money out of that treasury over the next little while. And I've got partners that are going to be moving these projects forward. So look towards that flow of news coming out of these projects going forward, and pay very close attention to the value of the manganese deposits when we finally get a PEA announced into the market. I think you're going to be surprised just how significant this asset is. There's still a good deal of work we have to do to nail down operating cost, capital cost, and really to start to demonstrate to you, the shareholder or investor, what the eventual internal rate of return and net present value on this project are going to be. But certainly with a market cap right now of 6.6 million, really you're not going to get a much lower share price than this coming into the market. So it really is an excellent entry point as an investor to come into the stock and to take a position as we start moving this project forward. Certainly there's enough potential here to demonstrate that this story has got a lot more legs to go. Thank you very much. And once again, my name is Warren MacLeod. I'm very accessible, so feel free to give me a call anytime. I'm happy to answer your questions.